This is Bloomberg Surveillance Early Edition with Dani Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. China's economy continues to lose momentum. Manufacturing contracted again in June as calls grow for more policy support. In moments, we're going to get a fresh read on euro area inflation that may provide more clues on future ECB hawkishness. Key U.S. inflation data also hits today. And Nike drops its full-year outlook, and it failed to win over Wall Street. There's concerns about its high stockpiles. Happy Friday. Welcome to Bloomberg Surveillance, the early edition. I'm Dani Berger in London. Kriti Gupta is in New York. Kriti, happy last trading day of the week, month, and quarter to you.
Right back at you. You know, what's interesting is we've been talking about rebalancing all week long, and it feels like now perhaps a little bit of positioning showing up for what that back half of the year is going to look like. The pre-market action, Dani, is pretty interesting stateside, especially when you look at the bond market. We're going to get to that in a moment, but let's look at NASDAQ futures first because you are seeing a bit more momentum here. Green on the screen, higher by about 0.4%. A little bit of tech outperformance already, which is interesting because right off the bat, we have also gotten some news overnight about simply chip exports. So in theory, that should weigh on some of the big players, and yet it's not. NASDAQ futures, again, like I said, higher in the green. But again, this is going to come in a little bit of a low volume environment. Remember, we are headed for the 4th of July on Tuesday, so a lot of folks are taking the long weekend. Some have already left their trading desks. So really keep an eye on how much volume and liquidity plays a role, which brings me to the bond market, because again, those are common themes we're seeing there, but already a repricing happening there. A 2-year yield that's getting closer and closer to 5%, 492, already higher by about 6 basis points, almost 7. What's important is in the last 24 hours, Dani, you're starting to see the Fed swaps market price in 2 more rate hikes for the end of the year, even having major Wall Street houses like JP Morgan, for example, ditch their bullish Treasury calls. So already you're seeing that kind of show up in the market action this morning. In theory, as yields go higher, the dollar should follow as well. But I would say today's market action for the greenback is really a function of the euro. I'll let you tackle that story, but right now the Bloomberg Dollar Index higher by 0.1%. And of course, we love to look at the commodity story. You are seeing a lot of green on the screen, except in gold. Gold now testing that 1900 level, down about 0.3%. What does that say about kind of the risk on, risk off narrative?
Kriti, some breaking news to bring you that you alluded to. Euro area June consumer prices have hit. They are higher by 5.5% year over year. That is less than the estimate of 5.6%. We've had an immediate reaction in the euro that is to weaken versus the dollar. Now, stocks have mostly been unchanged on that news. That is, they are higher and they continue to move higher. Green everywhere throughout the regions. Kriti, you pointed this out to me this morning. FTSE MIB, it is now on track to close at its highest level since 2008. Some of those cyclical stocks that live in Italy, like banks, doing well. This has been a very good week for cyclical European stocks. Maybe, again, some quarter-end type movement. Let me take you into the cross-asset picture because, again, it is in reaction to that euro area data we got. We're looking now to euro that is weaker versus the dollar by 0.2%. It was stronger before that data hit. An immediate plunge in terms of strength in the euro. Sterling, that's only slightly stronger versus the dollar. Maybe unwinding some of the bearishness we had this week, but we had a whole bevy of UK data. Everything from house prices, which maybe didn't fall enough, but just falling in general, showing concerns there. And then we also had GDP for the quarter. 0.1% is how much it grew. So European stocks hold up. And finally, that inflation data hasn't really changed the fact that we're selling bonds, which you might expect. But Kriti, it's very possible that the German bond market is basically just tracking the U.S. in terms of that sell-off. So German 10-year yields, those are higher by about 3 basis points.
Yeah, certainly something we're going to be keeping an eye on both sides of the Atlantic. But let's go across the Pacific for a moment, Dani, because the one thing we haven't talked about at the start of the show is what's going on in China. China's economy lost even more steam in June. Manufacturing activity contracted again, and other sectors failed to build momentum. Joining us now is China economy and government editor Jill Deeses. Jill, what do we learn from the PMI survey we got about the state of the Chinese economy? Walk us through the data here.
Sure. Yeah, thanks, Kriti. So look, ultimately what we're seeing is this continued slowdown, this loss of economic momentum in China. There wasn't a ton of huge surprises from the data today, but ultimately we saw factory activity continuing to contract for a third straight month in June. That's never been an extremely strong indicator this year as the rebound has continued, but still some signs of trouble there. But then the other thing, too, is that while activity for the non-manufacturing gauge, this is the one that measures services activity and construction activity, activity did expand in June, it's ultimately not expanding at quite as strong of a pace as it was in May. And so what that's telling us is that there's some indication that some of the rebound is losing a bit of momentum there. I will point out that in addition to that, there were some of the smaller sub-indexes that were quite interesting. We saw a bit of a pullback in employment in the services, non-manufacturing sectors there. I think that's a pretty big sign of concern for the Chinese economy, because we've already seen some other indicators suggesting that youth unemployment, for example, is at record highs recently. That's kind of where, if there's that pullback in hiring in the services sector, that's where you're going to see some of that reflected. And ultimately, if unemployment continues to be a problem, we can see that spill over into lack of household confidence, which has been perpetually this issue over the last several months. And then ultimately, that might translate into a further pullback in consumer spending. So all of these just combine to give you some further signs of weakness in the Chinese economy right now.
Jill, are these data points enough to push the PBOC, to push policymakers in China to have more stimulus, to do something that looks a little bit more shock and awe type levels of stimulus than what they've done so far?
Well, I don't think that we're going to see shock and awe type stimulus levels out of China right now. So what we've been so remember earlier this month, the PBOC did cut a key policy interest rate. We've been surveying some economists who say there might be one more of those maybe by the end of the year, though I think the median estimate has maybe a much smaller policy rate cut. What everybody's looking for, though, are other fiscal measures. If there's going to be anything bigger and more dramatic that could maybe boost the economy on a more holistic level. I think that that Beijing right now, though, has a lot of constraints that are facing policymakers at this point. Remember, local governments still have quite a lot of debt that they're reckoning with. There's all of these different things that kind of go into the calculus here for policymakers, and I think they're going to be quite constrained in the amount of stimulus that they deploy. We've been hearing that from quite a few economists. I will just point out as well, remember that growth target for this year that policymakers set back in March, it's only around 5%, and I think the economy is still, there's a pretty low base of comparison with last year. The economy is still projected to grow well within that range, and so policymakers have been signaling for quite some time that whatever is coming in terms of policy might not be super big, but it's possible that we could see something in the coming days and weeks.
Jill, thank you very much. That's our China economy and government editor, Jill Desis. Now, Nike shares are falling in the pre-market trade. The sportswear firm posted less than expected fourth quarter earnings per share and a disappointing outlook. Now, its sales beat forecasts, and analysts also highlighted Nike's better than anticipated performance in China as a bright spot. Joining us now is Bloomberg consumer goods reporter Dasha Afanasieva. Dasha, first off, with these numbers, what is the read across here to the broader consumer sector?
Well, I think what came across from the analyst call is that there are concerns about the strength of the consumer. So particularly, the CEO talked about a promotional marketplace in the context of the high inventory levels that you mentioned, and also talked about consumer weakness, defining that as part of the reason why they had this quite conservative estimate for the full year that the market didn't like.
Nike is such a fascinating story simply because of that exposure to China as well, which in some ways is kind of seen as that retail bellwether as well. But speaking of perhaps retail bellwethers with exposure to China, Shein considering an IPO in the U.S., it could be met with some pushback. Walk us through why it's so controversial.
Well, Shein is at the center of a number of different contentious issues, namely labor standards and accusations that it uses forced labor in its supply chain, which it denies. Bloomberg recently did a story about how traces of cotton found in Shein products and then imported in the US actually came from Xinjiang province that's accused of using forced labor. There's also the US-China trade dispute that's obviously relevant because the US is a big market. And more broadly, fast fashion and its impact on the environment, the impact of very, very cheap clothes that people buy in huge quantities and then end up in landfill.
Certainly something we're going to be keeping an eye on, of course, to see if those claims are even substantiated, given that the company has, of course, denied the IPO as well. Bloomberg's Dasha Afanasieva walking us through that story. Another major consumer story that we are watching this side of the Atlantic as we head into the holiday weekend. Well, airline delays still sticking around. JetBlue now joining United in blaming federal regulators for the worsening congestion that has left thousands of customers stranded. Joining us now is Bloomberg's Sid Phillip. He covers transportation and logistics around the world. Walk us through this story. This week has been really fascinating, given kind of the fighting words between the FAA and United specifically.
Absolutely. So there's a lot of finger pointing as the airline industry braces for what's going to be a very busy flight weekend ahead of the Independence Day holidays. And the airlines have been blaming the regulators, saying that the regulators haven't staffed up air traffic control, and that's partly the reason for worsening congestion. The FAA has come back and said that essentially they're not responsible and weather has been responsible, and they've sort of pushed back on those sort of by the airlines' claims, saying that they are responsible for the delays and cancellations. But the net result is that people have been left stranded at the airports and there have been delays and cancellations.
I mean, there's been so much frustration everywhere, Sid. You know, the bullwhip effect of the pandemic, meaning we have these labor issues and just these general airport issues. Where's the light at the end of the tunnel? How does, again, it's not just an American problem. We feel it here in Europe and in London. How do we sort through this?
So it is a worldwide problem, and essentially the rapid rebound of aviation from the lows of the pandemic has come with loads and loads of problems, especially in terms of staffing for airlines, in terms of being able to sort of hire up and bring in people and train them. And I think that's a real concern for the industry as we get into a second summer after the sort of pandemic. And I think people will be looking to see if the airlines and the airports and others have actually made sort of good on those promises about staffing up, ramping up staffing throughout, and preparing themselves for the busy period. And this is really the major test for the industry, because it is a very busy weekend for travel in the US, and some of the airports like New York and Denver, where there have been issues, there will be some sort of looking at what's going on and whether or not the industry is ready for it.
Sid, thank you very much. That is Bloomberg's Sid Phillip. Now, coming up, EU Leaders Summit in Brussels is underway. We're going to bring you the latest next. And we're also going to wrap up the first half, look ahead to the second half. We're going to be doing that with Kevin Gordon, Charles Schwab, Senior Investment Strategist, later this hour. Plus, get ready for some technical analysis. We're going to be speaking to strategist Jay Woods of Freedom Capitals about the charts, about the lines on Bloomberg.
We are focused on getting to a place in which we get inflation down and that we can still support growth within our economies. I'm confident that we are still able to do that. And that confidence is underpinned by the record levels of employment that we still have and by consumer sentiment that continues to be positive.
That was Eurogroup President Pascal Donohoe there, speaking exclusively to Bloomberg's Maria Tadeo at the EU Leader Summit in Brussels. And let's get over to Maria. Maria, I want to talk about the Leader Summit, but first, you know, we've got to talk about your first love. That is European eco data. We just had inflation numbers out a bit ago. We had core ticks up, lower than estimates, though. What do you make of it?
I thought Bloomberg was my first love, but beyond that, look, when you look at the numbers that we've seen, yes, there is a cooling down in inflation. We're seeing it in the euro area. We've seen it in some of the biggest economies. But to me, the fundamental question, and I don't think there's a clear answer on this yet, is this definitive proof, and this is what the European Central Bank wants to see, that inflation is now on a downwards trajectory that will be maintained across time so they're able to hit that 2% target. This is a single mandate central bank. They have to hit that target. Otherwise, their credibility will be heavily questioned. Now, we know that for July, there will be a rate hike. The question is, what about September? They have said, yeah, we stay persistent on inflation, but we also monitor the data. To me, now the real focus is what happens in September. Now, to look at the political side to this, we did hear this week from the Italian Prime Minister, Giorgia Meloni, who said the idea of just hiking is simplistic. It could actually be detrimental to growth and not really tame inflation. So there's a lot of play here, both for the central bank, but also for the elected officials.
Maria, I don't know what kind of economic indicator this is, but I feel like they just turned the lights off behind you. Luckily, you're still well lit, but, maybe trying to save that energy bill with inflation where it's at. Okay, look, you're at the Leaders Summit, and of course, one of the big topics there is Ukraine. They aspire for NATO membership. Does it look like they're going to get it?
Look, this is such a crucial question. And as you know, for Ukraine, the cornerstone now of their foreign policy is to both enter the European Union and NATO. And they're very clear on this. In their perspective, in their eyes, the only deterrence that works is NATO membership. Now, yesterday, I should note that European leaders stayed until 1:30 a.m. in the morning debating about Ukraine, again, repeating this message of we stand with Ukraine, but also added now a step further, saying we will also contribute to future security commitments for the country. But again, this doesn't really address the issue of membership. And for that, we'll have to wait for the NATO summit that will happen in Vilnius. The Ukrainians want a clear line that says once the war is over, Ukraine will join NATO. Will they get that? Frankly, at this point, I don't think there's a consensus around it.
Well, Maria, speaking of the question of security, I want to go from Russia to China specifically. In the last 24 hours, we got new news about simply limits being put on the likes of ASML from the Dutch government about exporting to China. Put this into context of kind of the broader theme of how Europe is viewing China right now.
Look, and in fact, the two stories are heavily connected, because if you talk about Russia, you talk about security risk. When you talk about China now for the Europeans, there is an element of economic risk. And today, in fact, I believe now as we speak, they have already started to debate the idea of China. And remember, the commission, the head of the commission, von der Leyen, she says no to decouple, but yes to de-risking. The question is, what does that mean? And that's exactly the question I put to Latvia's Prime Minister, Mr. Rakins. Let's have a look.
We've never really had a European China policy, but it's in the making. And the mantra is the de-risking, taking the lessons that we've learned rather painfully on our previous high energy dependence on Russia.
And that was Latvia's Prime Minister, again, repeating the idea that, yes, you should take lessons from Russia and apply it to China. The problem with the idea of de-risking, of course, is that it sounds great. The Europeans can agree to it. The Americans obviously love it. But what does that mean? I think when you look at the different member states, they have a different opinion as to how to treat China on the trade front.
Yeah, it's such a good point, that divide there. Maria, thank you so much, as always. That's Bloomberg's Maria Tadeo in Brussels. Now, Allianz plans to build out alternative asset classes. That's according to the CEO, Oliver Bäte. We're going to have more on his plan and what he told Bloomberg next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Dani Burger in London. Kriti Gupta is in New York. Now, some of our top corporate stories. Allianz plans to push deeper into alternative assets such as real estate. That's according to CEO Oliver Bäte, who spoke in a wide-ranging interview with Bloomberg News. Now, he also said flows at PIMCO have stabilized, but are still shaky as investors assess the outlook for interest rates. PIMCO did manage to attract 14 billion euros in the first quarter, after 4 quarters of outflows that Kriti totaled something like 75 billion euros. But it's interesting because it's not just the market action here. It's the fact that if I want to go out and buy a bond fund, I can just buy TLT, I can just buy a passive fund, I can buy something with low fees. I don't need to pay up for an actively managed fund. And PIMCO and Allianz's CEO, to some degree, realize that when the flows start coming back, it's not necessarily going to go to them.
Yeah, and I think the best way to kind of phrase that, perhaps lack of incentive to really hop in the market in that way, is exactly what he said, referring to kind of the ability of the investment strategy to really beat the market. He said, look, there's just not any alpha left in a traditional treasury. And I think that's really important given it's not just about inflows and outflows. This is coming on the heels of them dealing with the banking turmoil and the kind of fallout of that, as well as a hedge fund blow up, which I think cost them something like $6 billion, Dani. So they're really struggling here to make that marginal dollar.
I will say they flagged real estate as one of the areas they want to go more into. I get it, you can charge higher fees, but they have defaulted on an office property in the U.S., so not all clear there. Kriti, we're also tracking Goldman Sachs. It's lost its ranking as the world's top M&A advisor for the first time in 5 years. Bloomberg data show that JP Morgan is now the top deal maker globally with a role in $284 billion of transactions. Goldman slid to second place, and $237 billion of deals is where they stand. Bankers are facing one of the worst periods for M&A in the last decade, with global deal volumes falling 42% this year. So, Kriti, I wonder if Goldman can just kind of brush this off and say, okay, this market is weird. When deals come back, so will we.
Yeah, it's interesting that this is coming in the M&A ranking, because if you look at kind of what Goldman really specializes in, they also had a really big stake in the IPO market specifically. And now with the IPO market kind of drying up, the M&A space isn't giving them that tailwind to perhaps make it up. So let's see if they recover perhaps in the back half of the year, but perhaps no surprise that JP Morgan is back on top, especially given they're on top of trading revenue as well.
Yeah, certainly. All right, Kriti, coming up, we're going to get back to the market story and what we're expecting for the second half of the year. We're going to be speaking to Kevin Gordon, Charles Schwab, Senior Investment Strategist, next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. China's economy continues to lose momentum. Manufacturing contracted again in June as calls grow for more policy support. In Europe, Euro area core inflation re-accelerated in June, a setback for the ECB that may reinforce its determination to raise interest rates next month. We get key U.S. inflation data as well at 8:30 a.m. Eastern Time. And on the corporate front, Nike drops as its full-year outlook failed to win over Wall Street analysts. There is concern about those high stockpiles. We'll dive into it. I'm Kriti Gupta in New York with Dani Berger in London. Dani, a lot to digest here, but I got to say, I feel like the bond market is taking the cake when we're talking about repricing and really perhaps that sensitivity to the inflation data we're getting on both sides of the Atlantic.
Yeah, I mean, that bond market sell-off yesterday, Kriti, it was steep, it was violent. It also comes off the back of the biggest net long, according to JP Morgan's survey, of treasuries since 2010. So the positioning, the pain trade clearly was yields up, price down. And that's the action we continue to see in Europe. In Germany, yields are higher by 2 basis points when it comes to the 10-year yield. Elsewhere, I got to say, it is remarkable to see how strong risk has been behaving this week here at the end of the month, the end of the quarter. It's a really strong session thus far for European equities. The FTSE MIB on track to end at its highest since 2008. And it's cyclicals that are getting us there nonetheless. Now, there's not clear evidence, perhaps, that we're heading towards anything like a recession in Europe. Inflation data, though, we did get that about 30 minutes ago. Consumer prices rose about 5.5% for the euro area year over year. The estimate was for 5.6%. So it is lower than estimates, but let's be honest, that is still too sticky for the ECB. Regardless, euro moves lower, weakens versus the dollar. Sterling, though, just ever so slightly higher, Kriti, but it's had a very, very bad week with that strength coming from the dollar.
I love that you mentioned the cyclical trade here, because I have to say it's not something we're seeing, that leadership, it's not something we're seeing stateside, but perhaps there is a theme, this idea of simply risk-taking, risk appetite, at least in today's trading session. I think a good way to look at that is through NASDAQ futures, higher by about 0.5%. But what's interesting is when we think NASDAQ futures, we think, okay, well, it's technology, it's a defensive play at the top of it. But remember, a lot of these big tech plays, especially after this kind of AI craze took over, have a lot of beta attached to them. So what's important to keep in mind mind is that perhaps that risk-taking that manifests in cyclicality in Europe is manifesting as kind of high beta moves in the NASDAQ story. We're going to get a little bit more insight in our next two interviews. But for now, take a look at the bond market. The 2-year yield at 491, already a move higher about 5 basis points. I think a continuation of some of that market action, Dani, that you were just talking about. But with those yields higher, the dollar follows as well, at least marginally. A lot of it is a function of what you're seeing in euro, that weakness that you are seeing on that side of the Atlantic. I think what's interesting, though, is that even though we are seeing this kind of risk-taking ability this morning, it's showing up in commodities as well, everywhere except for in gold. 1904 on the precious metal, down about 0.2%. What does that say about the bid for defensives, and how is that translating into the tech trade? Which brings me into a really fun chart. The idea here simply that this is going to be the best half for the NASDAQ 100 going all the way back to 1999. That could be a big concern for a lot of people who are saying, is this reminiscent of that kind of dot-com bubble? Others might say that actually this is really based and kind of driven by the fundamentals, by massive investment on the AI front. Let's see what our next guest has to say. A true expert, Bloomberg cross-asset reporter Denitsa Sokova joins us next. How does this kind of rally, this margin of rally, compare to what we might see in the back half of the year?
Yeah, so that chart is obviously incredible. If you look at this, is the best first half ever. But what is more incredible, if you look at where we started this year, this was the year with the most bearish forecast for the S&P 500 and U.S. stocks in 2 decades. So we started from a place where the positioning was bearish, people were waiting for imminent recession, and the type of chart we're seeing now is not what people were expecting. Kind of the consensus was that bonds will outperform stocks, that U.S. stocks are going to underperform international stocks. And we had a lot of the big banks saying that, you know, we may see the 2022 lows being retested in the first half of the year. Of course, now looking back, those things didn't materialize. But the important thing is we started from a very bearish place, which to many people is a good sign. It means that there is buying powder, and from all that bearishness, we can see a short squeeze, and that's what we saw from fast money traders. Another thing we saw is active managers were actually under position in mega cap. So what happened is they were also chasing the rally. So the question from here going forward is that all of that bearish ammunition exhausted, or is that the start of a strong momentum upwards for those assets?
Is it, Denitsa? What do strategists say? Is this the start of continued momentum?
Yeah, so what we're seeing is very interesting. It's kind of split in between. If we go back at the start of the year, everyone was bearish. Now we're seeing 2 camps. We're seeing a lot of big banks like Goldman Sachs upgrading their targets, and they're predicting significant upside for the S&P on the year. Like, the consensus was the S&P was going to be flat, and now we're seeing people saying, oh, it may be up 70% on the year, which is obviously a big number. But then there is the other camp, which kind of plays with that thesis, which we've been talking all year about, delayed recession, you know, those intense rate hikes will take a very long time to trickle down to the economy. So that camp is keeping all their gloomy forecasts that, you know, there are so many things predicted, and they're just pushing them later on. So the good news about it is that there is still enough bearishness. So if we say that bearishness helped the rally, there is still enough of it. But the question is obviously how far can it go?
Denitsa, thank you so much. Denitsa Tekova there from our markets team. Let's get more into the markets conversation. Kevin Gordon, Senior Investment Strategist at Charles Schwab, joins us now. Kevin, thanks so much. Great to have you in the studio this morning. Look, so many people got this year wrong. So many people got last year, the year before. Basically, it's been a spat of having a very difficult time in this market. For the second half of this year, how much conviction do you have on where we head from here?
You know, I think in general it's a low conviction environment. And, you know, it's just tough because we're still dealing with so many vagaries around COVID. But when you talk about, you know, risks and you think about, you know, first half versus second half, I think what's going to be interesting is this widening out, or the widening out we're waiting and broadening out in breadth for the market. And, you know, up until maybe a month ago, it was the case where you had pretty narrow leadership, widely advertised, only a few, you know, handful of stocks that were driving the rally. That started to change a little bit in June. And in our mind, we would get a lot more constructive if you continued to see that. So more participation down the cap spectrum from cyclicals. I think one of the areas you're seeing it the most is in industrials. But something that maybe has the potential to kind of sap that, I think, would be any downturn in earnings. So if you don't get any uptick, because at this point, multiple expansion has basically been driving everything since October. You haven't yet seen a positive contribution from forward earnings. If you get that, I think that's a really bullish scenario. But if you don't get that and you sort of stall out, I think that's a potential risk that's kind of looming, especially because you're now more than 8 months off of the low in October.
Right.
Anytime after that, you need to start to see earnings kick in.
Well, the macro data has been strong, especially in the U.S. Does that give you hope that we do see something beyond multiple expansion, that these companies are going to actually start turning out very strong earnings?
I think that's the bullish case, and especially when you think about small caps, which haven't been participating as much, the macro data improving, that's the best case scenario for them. The obvious catch with that, and we'll find out today with the PCE data for the Fed for inflation, if inflation catches up in conjunction with that, I think the Fed would view that as an issue. So I don't think that this Fed right now is battling financial conditions like they were last year, and we got evidence of that from Powell's words a couple of days ago in Sintra. But I do think that's a building risk as well, where you might have a little bit more hostility if inflation takes much longer for them or to get to the goal that they're hoping for.
Well, Kevin, let's stick with the kind of pain trade, or perhaps what the Federal Reserve is going to do. Overnight, a 15 basis point move in the front end of the curve, at least stateside, we were looking at the 2-year yield, really pricing in 2 more rate hikes for the end of the year. Does that matter for a stock market? What's priced in here?
Well, what's interesting is that the relationship between bond yields and stock prices has just grown less volatile, I would say less hostile versus last year. So I think that's a positive scenario. That's a little bit more of a positive backdrop. But, our thinking hasn't been as much on the number of hikes or how many more we have left to get to the end terminal rate. It's much more about holding and how much the Fed and how long the Fed wants to hold theirs. I think that's been more of the focus. And Powell successfully, I would argue, has been really trying to sort of price out rate cuts for the end of this year, which last time I checked the terminal, that was still the case. And then I think moving into the beginning of 2024, I think they really want to stay focused and get the markets focused at least on the fact that there's really not going to be any immediate pivot to rate cuts or rate easing, especially when you have the revision we had to first quarter GDP, the fact that the inflation metric that they track the most, the core ex-housing services component of PCE just isn't easing in any way, whether it's month over month or year over year, that they would be hoping for.
Well, Kevin, let's talk then about how that does translate into the tech sector specifically. You mentioned the breadth rule and that you are starting to see that concentration expand out a little bit. But how do you view these tech stocks? Is it still a defensive trade given this kind of leaning towards kind of artificial intelligence and these other, I want to say, riskier investments and innovations? Or is this still kind of viewed as perhaps very exposed to business investment? What do you kind of classify tech as right now?
Well, putting the AI trade aside, I guess for a sec, that trade really started to, the tech trade really started to do well and outperform. I'll call it the large cap growth trade, started to do well when you started to see the banking stress and the implosion of SVB and Signature Bank. That drove this massive split between small caps and large caps, particularly up the quality spectrum. So in that sense, the rally for tech hasn't been unjustified. I mean, directionally, I think that makes a lot of sense. And, back in the pandemic shutdown days, tech was basically the haven trade because those were the companies that we were living in and sort of relying on in that time. And it's not the case that we're not relying on them anymore. It's just less so. So I think that the share that they have of overall earnings, and you compare that to sort of their market share, that's grown a lot wider. And I don't think that that's the necessary reason where you have to have some convergence and they have to completely catch down. And so it makes sense from a quality perspective. But the way that we've been thinking about breadth in this rally is that when you go through these big cycles and you have major market lows like we did in October, at this point, and you can go back nearly 100 years in market data for this, you tend to see better participation. You have a lot more stocks in the S&P making a new 52-week high. You have a lot more trading above a 200-day moving average. Same thing when you broaden out to the Russell and then to the NYSE. So I think that's probably where I would find the most maybe risk moving forward is if you don't get that broadening out, because that, to me, would kind of result in a little bit more of a nasty convergence.
You know why I like this conversation, Kevin? Because there's too many doomers out there right now, and that has not played out. So it's nice to get some realism, a breath of fresh air. Kevin, thanks so much for joining this morning.
So
Kevin Gordon of Charles Schwab. Now, coming up, we're going to turn the conversation to technical analysis. We'll be speaking with Jay Woods, Freedom Capital Chief Global Strategist, who joins Kriti and me next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Dani Berger in London. Look, it is the last day of the quarter, the month, the first half of the year. So how do you position for the back half when you have seen a lot of green on the screen in the S&P 500? Specifically for that, I want to bring in a true expert on the technicals, because the question here isn't the fundamentals necessarily. It's how do you navigate it, even in a time when perhaps more and more people are getting a little bit bearish. I want to bring in Jay Woods, Chief Global Strategist over at Freedom Capital Markets and a long-time broker at the New York Stock Exchange. So we like to bring you on for the nitty-gritty on stocks. All right, get ready, throw it at us. How do you play the S&P 500? Walk us through the technicals.
It's been a slow grind. It's been kind of boring, and bull markets tend to be boring, especially when you're coming out of, what was a pretty aggressive bear market. So it's been frustrating. You're not getting the volatility that we're used to. The 1% or more swings intraday aren't happening. This is good. It's been a very constructive rally to me. We broke above the August 2022 highs at 43.25, and we just tested them literally to the point, and we rallied. So I think we're going to see a lot of sideways action. The thing to me is the broadening of the rally, because too many people were focused on that Magnificent Seven, and we're seeing it. We're seeing it in the Russell finally catching up, having a great June, and a few other sectors that I like the industrials.
Can that get us to 4,500, Jay?
Yeah, I think 4,500 is a realistic target. It's not too far from where we are now. And, technically, the setups are there. Now, what can take us above 4,500? I don't see what that catalyst is going to be. But what I do like is the rotation we're seeing underneath the surface. And to me, it's constructive. But it could set up for another boring 3 to 6 months. There is really nothing that's going to move the needle. But to the downside, we do have some good support levels that I think should hold. We focused on 4,200, breaking above it for so long. That old resistance should be support when tested.
I mean, look, a boring market is wonderful, especially considering the volatility that we've seen. We all want boring, but I personally want the drama, Jay. I want the excitement. Talk to me about industrials. You mentioned it. Where is the excitement going to come from in this sector?
Well, that's where we're hoping it's going to come from. The industrials have been basing for quite some time. And what I look for, especially as a technician, are those long bases and something to change. And we look like we're on the verge of a breakout. What could that catalyst be? Right now, within the sector, the defensive stocks have been doing really well. You want to look at something like the ITA, the defense sector. But within both the defense sector and the industrials is a big down name called Boeing. Boeing has finally reversed, what was a really ugly downtrend for quite some time. It's basing again. It's making higher lows, which is very constructive. Once again, it is boring. I know you want action. As a trader on the floor for so many years, there's nothing better than a crazy day. But we need to build bases, have this constructive rally, which I think we're seeing. And if you're going to watch one stock that could break the industrials out, it's Boeing. If you look at that chart, long-term downtrend. Trend has changed, so that's good. It stopped going down. As simple as that is, that's a positive sign. And now what has it done? It's taken a leg up, and it's consolidating here in this nice range, and it looks just like the industrial pattern itself, that it wants to break out, and it has a lot to reverse. So keep an eye on Boeing. That could be the tell for the industrial sector going forward.
So let's broaden this out again, because Boeing, as you mentioned, is not just a heavyweight in industrial and defense, it's a heavyweight in the benchmarks as well, the S&P 500 and the Dow as well. When it comes to today's trade specifically, it's the last day of the month, the quarter, the first half. Talk to us a little bit about what could kind of change today's trade. Things perhaps like the student loan forgiveness, SCOTUS decision. Is that going to have some sort of market read-through?
Well, today first the PCE. I think that, being the inflation gauge that the Fed likes to watch, that could move the needle if we get a surprise there. But yes, student loan debt has been the chatter on the floor. It's a chatter everywhere, actually, because it's going to affect a lot of people and how they spend. So we'll see what happens. We'll see how that affects discretionary spending going forward. So I think that could be one of the bigger stories going into the second half of the year. And then the other story I look for are some of the beaten down names. What were the leaders this year? 3 of the top 10 winners, we know all about AI, were the cruise lines. Well, those were the most beaten down sectors. They have a lot to reverse. I look for stocks that were beaten down. Yes, they may be up 50, 70%. But given the max drawdown that they had, there's still room to run. A stock like Generac is a stock that I follow that, yes, it's up 45% year to date, but it's still 35% lower than it was a year ago, 12 months ago. These are the things I'm liking to see, constructive turnarounds in a wide range of stocks.
Yeah, and I have to say all of them kind of volatility plays as well, or have been in the past 6 months or so. All right, final word, this back half of the year, are the gains going to stick? What do you think?
Yeah, I think the gains stick. Traditionally, when you have a good first half, it's followed up by a strong second half. There aren't too many X factors. The Fed has telegraphed every move. We didn't really even blink when he says we may do 2 consecutive quarter-point rate hikes. So I am very optimistic that things will continue to be on the upward trajectory. I just don't see it running away. I don't see it, being too exciting. But I'd like to see more participation, and I think that trend will continue.
Jay, you're breaking my heart. I will, again, come back with us, come back with the drama. But hey, it's good news all around. Jay Wood there of Freedom Capital Markets. Thank you so much for joining us. All right, coming up, a host of U.S. data in your daily brief. We're going to get to that next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Dani Burger in London. Kriti Gupta is in New York. Let's get you set up for the rest of your day and take a look at what's ahead. It's the end of an era, everybody. LIBOR, it's going to have its last fixing at 6:55 a.m. Eastern Time. A decade in the making after a 50-year history. RIP LIBOR. We're also going to get a slew of U.S. data. That's going to start with PCE, deflator, the Fed's favorite measurement, and personal income and spending at 8:30 a.m. Eastern Time. UMich consumer sentiment. This is just the final reading, so we'll likely just get a confirmation of what we had earlier in the month. That will hit at 10 a.m. Eastern Time. Plus, we're going to get some consumer earnings. Those are going to continue with Constellation Brands reporting. Kriti, that will happen before the U.S. Open. What are you looking at ahead of the Open?
Well, we got to talk about some of the earnings that we got in the last 24 hours or so. Nike is at the top of that list, Dani. Essentially, we look at it not only because it's a major retailer stateside, but it also has that exposure to China as well. Shares down about 3.6%. They're saying, look, the inventory is still an issue. We're beating our sales. We're beating our forecast, but it is still not enough when it comes to our full-year outlook. So that stock definitely getting weighed down this morning, down about 3.6%. But speaking of getting weighed down, I want to talk about the chip sector a little bit because this has become a geopolitical story that's having a very real read-through into the markets. ASML, the Dutch equipment maker, down about 1.7% as the Dutch government says you can't export to China anymore. That is a big deal for a company like that. What's interesting, it's not having a read-through into the U.S.-based tech names. Micron Technology, NVIDIA, Intel, all higher on the day, Dani. And lastly, we should talk about travel as well, because if we're talking about things in the red, United Airlines has really been in the news. You're seeing the airlines broadly see some delays and right now not really able to hold their own when the rest of the market seems to be a little bit more optimistic.
See, this fascinates me because there have been plenty of issues here in London, not recently, but every now and then there's a strike at Heathrow. Sometimes you're traveling to France, there's air traffic control strikes there. Kriti, it is this global story of demand for travel post-COVID. And it's a problem, and it's also a problem if you want to travel at a reasonable rate. Everything is so expensive right now for flying, and it's hard to do.
It really is, and I think you have to kind of parse out how much of this is a post-COVID kind of hangover as opposed to some individual airline issues. Remember the Southwest chaos? How much of that are you seeing become a very specific airline issue as opposed to kind of some broader story?
All I'm saying is I'm trying to plan my summer holidays. I'm not trying to spend my life savings doing so. All right, that's it for Early Edition. Enjoy the rest of your Friday. Surveillance is ahead on Bloomberg.